Are you taking a calculated risk in the bond market? What is life without risk? Risk hai?
तो इश्क है.
You all might have heard of this. But would you say the same for investments as well? Probably not. Hence, when it comes to bonds, you also need to know about the bond market risks. And that's exactly what we are planning to discuss today. Today, we will understand the risks involved in the bond market and help you make an informed decision in your bond investment journey. So let's get started. Bonds can be an excellent investment to generate income and widely considered to be safe, especially compared to stocks. However, you investors should be aware of the potential pitfalls of holding bonds. So let's dive deep into the risks that you should consider. Number 1. Credit or default risk. As the name suggests, this risk is concerned with the issuer's ability to make timely payments of interest and principal repayment. If the payments are not made on time, the issuer is said to be in a default. Number 2. Market risk. Market risk correlates to the inverse relationship between bond prices and interest rates. Bond prices tend to fall when the interest rate rises and vice versa. When you hold a bond until maturity, this risk is not a concern. However, for investors who plan to sell the bond before maturity, market risk is a factor you should consider. Number 3. Reinvestment risk. In simple words, reinvestment risk is the probability that investor will not be able to reinvest the coupon payments at a rate comparable to the bond's current return. For example, a bond's coupon rate is 8%, while the prevailing market rate is 4%. The 8% coupon earned currently will have to be reinvested at 4% rather than 8%. But a point to keep in mind is reinvestment risk does not arise if the bond is a zero coupon bond. Number 4. Call risk. Simply put, the risk that the issuer will exercise a call option is known as call risk. Such risk is specifically associated with the bonds that are embedded with a call option that allows the issuer to buy the bond back before maturity. When market rates decline, callable bond issuers often look to refinance their debt, thus calling back the bonds. This often leaves their investors to reinvest their bond proceeds at a lower rates. Such investors are, however, compensated by high coupons. The call protection feature also protects the bond from being called for a particular period, giving investors some relief. For example, 950 South Indian Bank bonds had a call option on 28 November 2022, although the bank refused to exercise this call option, which was a management decision, considering that South Indian Bank would have had to raise a debt at a coupon of 13.75% or above as per the prevailing market rates at the time. Ultimately, the investors were at a loss as they could have deployed their funds at a higher coupon rate had the call date been exercised. This event resulted in a severe fall in the bond prices for this ISIN. Number 5. Maturity risk. The maturity risk is the risk of experiencing a negative shift in market interest rates associated with investing in a bond with a longer maturity. But the maturity risk can be reduced by buying bonds of different maturities. Number 6. Inflation risk. Inflation is a serious concern for investors as with the rise in inflation, the purchasing power declines. The same amount of income will buy you lesser goods. For example, the average fixed deposit rates during April 2023 were at 7.1%. Considering a tax slab of 30%, the returns would be 4.97%. And after adjusting for 4% inflation, the investor would be left with only 0.97% returns on their investment on a FD. Investors should look at maximizing the returns by investing in bonds through SMEST. Number 7. Liquidity risk. You might know what liquidity is, but if not, let me give you a quick explanation on what it is. Liquidity, in simple words, refers to the ease at which an asset can be converted into cash without negatively affecting its market price. In the bond market, the liquidity risk concerns with the ease at which a bond can be sold before maturity. This is a risk that an investor may have to sell the bond at a price lower than the expected price. Number 8. Political and legal risk. Now, political and legal risks are two closely related risks. These risks relate to potential changes to a country's governmental policies or laws, which may have an adverse effect on the market value of bonds. For example, in Budget 2023, an amendment was made in taxation of MLDs, where the old regulation was investors who sold MLDs in a short period of time will be taxed at 10% on the gains. 2. As per the new regulation, MLDs will now be taxed at investors' tax slab, making them a less lucrative investment option. Number 9. The event risk. The risk of certain events occurring is called as the event risk. The events such as natural disaster, industrial accidents, corporate takeovers, and lawsuits can affect issuer's ability to meet its financial obligations. The last on the list is sector risk. As the name says, bonds in different sectors of the market may respond differently to economic, financial, environmental, or interest rate changes relative to other sectors. The risk that the securities of a company in a particular sector will underperform in response for such changes is called as sector risk. Well, that's all for today, and I hope that you understood the various risks involved in the bond market. Visit SMEST.in and take the next step towards investing wisely. Also, stay tuned for many more exciting lessons coming your way. But before signing off, always remember investment in debt securities are subject to market risks. Read all the offer related documents carefully before you invest. Also, if you have any questions about this module, please leave a comment below. Bye bye, see you in the next one.